Bonjour à tous. Bonjour à tous. Et beaucoup mieux. Je vous apporte les salutations de l'Afrique de l'Est. Je suis Ramah, comme Ramah l'a dit. Je travaille avec Bloomberg. Je suis toujours heureux de traverser tout le continent que nous appelons chez nous. C'est heureux de venir au Togo, un beau pays.
Spend here, but we'll try and make more time in future. Monsieur le Président, you set up our initial conversation pretty well because it ties in very neatly with the conversations that we're just about to have. This is a continent of immense opportunity. And yet, the argument will be made that in some instances, we are unfairly tarred by the argument that Africa is too risky. It's a very, very risky place to do business. Yet barely 24 hours ago, Ethiopian Airlines announced a deal to buy at least 36 aircraft from Boeing. That doesn't sound like a risky continent to me. Some of the panelists you'll hear from here have only had about 2% of the guarantees that they have provided for finance across the continent called in the entire period of work. That doesn't sound like a risky continent to me. And yet that gap between perceived risk and actual risk still persists. Why? We'll explore that in detail. I'd like to bring up all the individuals we'll be having this fantastic conversation with. I'd like to start with Sérgio PIMENTA, the Vice President in charge of Africa for the IFC. Please come up to the stage. We'll also have Jules NGANKAM, who's the Group CEO of the Africa Guarantee Fund. He's going to be part of this conversation as well. Jules. Also with us, we'll have Patty Martin. She's a Managing Director of the Namibre National Insurance Corporation. If there's anyone who's better placed to give us a fine sense of how risk should be managed, Patty and her team certainly will give us a very clear idea of that. And finally, we'll also have Marufatu Abiola BAWUAH, who's the CEO of the United Bank for Africa. Please come up to the stage. Abiola, I'd like to start with you because UBA has a fairly interesting story. I remember back in 2010, I was a very rookie journalist back then. The argument was, why is UBA spending all this time expanding across Africa, getting into all these African markets? Looking at your numbers last year, however, that bet paid off really, really well because at least 45% of UBA's profits came from outside Nigeria. So looking forward into the rest of 2023, 2024, we're seeing all these, this significant pullback from all these other organizations coming out of African markets that fairly or unfairly are seen as being a bit too risky, or perhaps they're just not a proper product fit. Does that represent a growth opportunity for you?
Thank you so much. I think that's a very good question. For us in UBA, we are firm believers in Africa. So long before even people saw the opportunity, my chairman and his group saw the opportunity, and people were wondering, like the president rightly said, we decided to change the narrations of Africa. So, and if we don't do it, who else will develop Africa? We believe in the Africa capitalism. What that means is that Africa can only be developed by Africans. So he took that risk and it's paid off. So I think that there's no better time than to discuss today's title. That's the theme that is being discussed about Africa raising about 1.5 trillion. I was particularly very delighted about it, and I told myself this is the opportunity. So there are numerous opportunities. Yes, UBA is in 20 countries, but we are not done yet. We are going to move into all the other African countries, and we believe that there is no better way to do it. And like I said earlier, it's paying off. There is still numerous opportunity out there, and we are poised to take advantage of that.
So is the focus now organic growth in the markets you already have, or is it going to be acquisitions perhaps in those other 20 countries?
Well, both can be considered. I mean, today you see there's a lot of exit of the international players in banking. So we think that that presents a unique opportunity. So if there's opportunity for us to acquire, to merge, or even grow organically, I don't think any of it is off the table.
Indeed. Sérgio, I want to come to you because as the young ones say these days, it's talking is the easy part, but actually putting money on the table, that's what counts. And in IFC's case, you had $43 billion in commitments last year. I think that was actually your biggest year on record. 21% of that is right here in Africa. From where you sit, what's demand for capital like at this point? Because all of the macro numbers seem to be flashing red, right? You've got inflation going through the roof, 40% in some countries. Currencies are weakening. Where I come from, the shilling is down by about 25%. What's demand for capital like?
Well, thank you very much. It's a pleasure to be here. First, let me say that, as you said, there are numbers there and data there that sometimes can look not that exciting. But on the other hand, the opportunities are very significant and the demand is very strong. And I think His Excellency mentioned it in his opening speech, and look what the UBA is doing. Look at all the operations that they're growing and the successes that they're having. And as you said, for IFC, I mean, we had a record year last year with our $43 billion of deployed capital across the world, but we deployed 11.5 billion in Africa. That's the largest number ever. And why? Because we do see that there are opportunities, and we're also seeing shifts in this demand. And I think that's the trends that we all in this room need to focus on. One of them is the regionalization of the markets. The fact that, like EBA is doing, going to other markets, companies, banks, financial institutions in Africa are looking at the regional market, not just at the national market. And that's, I think, a very in-depth movement and trend that creates a lot of demand. I also think that you have to look at what the private sector is doing across Africa. I mentioned in my remarks earlier the role of the small and medium companies, because I do see there a huge demand for financing, a huge demand for support. Not just financing, we also provide, as you know, advisory work. And I think those two dimensions are very important. And then I think financial institutions, all of us have to accompany the changes that the continent is going through, whether it's urbanization, whether it's issues with climate change, whether it's all the opportunities created with digitalization. All that are areas that we should go and support.
Indeed, and we'll certainly come back to the nature of that support and how we provide guarantees around it in a bit. But Percy, I want to come to you with respect to the question of risk. And I want to quote the Africa Re CEO, Cornel Kerekezi, when we had a conversation last year. And this is actually from their annual report. The difference between insured losses and economic losses due to natural disasters will be significant in future. Of course, you're talking about the damage that is being inflicted by climate change. Not too long ago, fairly close to where we are, Nigeria experienced some really crippling floods. Somalia is being battered by the floods that they haven't seen in 100 years right now. We had the worst drought in 40 years over in East Africa last year. Various North African states are also suffering at the moment. Where do we find the capital to deal with all these climate risks? Because it seems like, it's one of those classical examples of the risk is way up here and we've got a thimbleful of capital to deal with it.
Thank you so much, Ramah. It's a very relevant question. Like you have said, it's the protection gap is where we're going to. It's very huge in the sense that most of our governments currently you have referred to the floods that are happening all over. So as a result of most of the countries going through these experiences of floods, that's definitely creating that there's a huge protection gap in the sense that when we take the insurance penetration, the cover that we have as insurance company is much smaller. And as a result of the huge protection gap, so when there are floods, mostly governments has to step in. And most of the time they have to take, it's impacting on the GDPs. where they have to take money that was meant for development and have to revert it for these events. Now, why I mention that, it's bringing us to, yes, as African reinsurers and insurance sector, we play a pivotal role. Sorry, I'm also needing water.
We'll certainly have some delivered at some point.
Sorry. Yeah, so that brings us to say that if we look at the reinsurance sector in particular, we we will definitely need an increase of financial capacity. And this, if we, for instance, take our balance sheets as the 5 top indigenous reinsurance companies, our capital together is 2.5 billion. So that means that obviously for us as African reinsurers, we normally take the risks together. So we have to build up more capital in order for us to make sure that we can ensure the growth that is expected in Africa. And I think together with that, we have also the challenge of, if we take our regulators, as we speak, Nigeria, for instance, have increased the capital requirements to 50 million. Ghana, we're speaking about 25 million. So yes, as African reinsurers and insurer sector, we have to provide the support for growth in Africa.
One of the things that we're going to be discussing in detail over the next 48 hours is, if we're going to essentially grow a lot of these organizations into Pan-African champions, where do we find the capital for that? What common rules of the road do we need? So my next question is to you, BAWUAH and Jules. The rules of the road vary significantly from one market to the next. One country will have very different capital requirements. Another market will probably have different rules of the road for how you structure delivery of services, for example, through mobile money, mobile lending, mobile savings, and so on and so forth. If you were to do a wish list with some of the regulators who are here on, look, we'd like to expand across Africa, but we need these rules of the road in place, what would be the top 3 things on that list? Let's start with you, and then we'll go to Jules.
Okay, I think in my view, the first thing we need to do is to take advantage of the numerous opportunity. Remember when I mentioned that there's a little bit of exits of the international financiers. I think that the African finance industry will need to take advantage of that. And for us to take advantage of that, we need to increase our capacities. We need to strengthen the governance system because we need to boost investor confidence so that others will be willing to come on board. So we need to increase our size, we need to increase our capacity, we need to believe in Africa and invest more in Africa. So the regulatory framework and the governance framework will have to be strengthened. The second thing I think we should look at is the harmonization of the financial regulatory system. I think that is very critical to boost that intra-African trade. One of the key things we are pushing in Africa is intercontinental trade across Africa. And I don't know if you saw the event in Ghana recently, where we signed $6 billion for SMEs with Africa. And we mean business. I think that if Africa must prosper, the inter-African trade is a must. It's not negotiable. And like the president said, is the engine of growth Africa.
So should we have those rules negotiated through the Continental Free Trade Area, through ZLECAf?
Well, it is going to be part of it, but I think the various central banks, the regional central banks, will have to interconnect so that we streamline the regulation. I think that will open the trade, that will remove all these artificial barriers that we are having. There is no need for me to want to import, let's say, a small thing as bonnets. You know what bonnet is? From Togo. and I will need to convert my cedis or my naira into euro or into dollars. So I think that we should look at all these artificial ones, so that once there's financial harmony, I'm not talking about the political, I'm talking about the financial harmony of our system, whereby I can go to my central bank in Ghana and buy CFA. I think that that will open up quite, to make the inter-trade quite easily. The third thing in my view is for us to begin to look at, to face what you just mentioned, the climate change is real, it's come to meet us. And I think for those of us who are alive, that is an opportunity to take a center stage. So for me, the financial industries, we will need to look for, those things cannot be done with overdraft. It cannot be done with short-term loan. So there will have to be greater collaboration between African financial industry and our development international organizations, so that we can raise the long-term funds both locally and internationally. And that will mean that we will need to come up with a lot of innovative products. Thank you.
Jules, you sit in a very interesting part of the financial industry that a lot of us on the retail end rarely ever get to see. Because on your end, at the Africa Guarantee Fund, you have to essentially ask yourself, is this a risk I can take on in my books? Is it an acceptable risk? What could possibly go wrong, right? But at AGF, you've pulled off some interesting numbers. And, you know, as Abiola is pointing out, we need to expand across Africa. Do we understand those risks properly? And B, from your end, what rules of the road would you like to see from regulators?
Okay. Thank you. Yeah, so what I would say, as you mentioned earlier, the challenge around the capital. I think I see two main challenges there. So the first one will be the secondary market. I think one of the main challenges we are facing in Africa is the lack of secondary market. Meaning, when we attract investors, there is something that we need to keep in mind, is that they are there for a certain timeline. So they are looking to exit at some point. But the fact that we don't have secondary market in Africa, meaning they have to hold their investment maybe until maturity. So that is a main challenge. And the second one, which is the most important one, is the lack of financial instrument to be able to cover our risk. Those investors, they have to face credit risk, FX risk, and today what we are trying to do as AGF is to bring solution at least for the credit risk. But the FX risk still remains one of the main challenge. You know, those investors, they will bring other currency, dollars, euro, to invest in Africa. The ROE might look very interesting, but when you see the depreciation of the currency, all the ROE that they made through the investment, they will lose it if they want to convert back to the hard currency. And even when we look at the intra-trade, that will be also a challenge. Like, you have cash in Naira, you want to invest, let's say in Lome or in Kenya, how do you do? You have to always to transit through dollars. So the fact that we don't have enough financial instrument to cover the risk. I want to give you a quick example. During COVID, the developed country, the most utilized instrument were guarantees. So the developed country around the world, they were able to disburse $5 trillion just for risk sharing, to be able to give more comfort to investors. And I do believe that one of the main challenges that we have in Africa is really this lack of type of instrument. You know, how to hedge your currency exposure, your credit exposure. Thank you.
And there's something that I noted that looks quite interesting from your annual report, which goes back into that question about the gap between risk perception and actual risk, which is the 2% number that I mentioned a little earlier, right? In AGF's entire existence, the total guarantees that essentially have been called in are 2% of your entire portfolio. Now, from where I stand, if I look at that number, I'll say, okay, that doesn't look like a risky portfolio to me. And yet that risk, that perception that Africa is a risky place to do business, if you're going to come in here, yes, there will be problems around currency. It'll happen, right? But that doesn't look risky to me. What does it look like from your perspective?
Yes, and I was very happy when the Excellencies mentioned that during his speech. You know, this perception gap. I think this is one of the major challenges that we are facing in Africa. We have a huge gap between the real risk and the perceived risk. And we are talking even about the sovereign level. You know, the Excellency was mentioning the fact that Argentina, despite all the default that they still had a better access to the capital market than most of the African countries that never faced any default, right? So it's a challenge. Now, when you bring that perception gap at the level of the SMEs, it's even bigger, you know. So we have that perception at the sovereign level, at the SME level, it's even worse. So what we are trying to do as AGF is to give comfort to investors, to tell them, okay, if you enter into a guarantee agreement, at least you will get to know better about the risk. I realize that it's not as risky as they anticipate. Because when you look at the history of the financial crisis, like that we had, you know, we had the tech crisis in the early 20s. That was not Africa. We had the subprime crisis. It was not Africa. We had the euro crisis. It was not Africa. So all the financial crises that we had around the world, during the whole history of the world, none of those crises came from Africa. But people still believe that it's the riskiest continent. No, so it's a perception. But again, how do we manage that? It's easy to complain. We can say, yes, the perception gap is big, but what instrument do we offer to investors to be able to absorb that perceived risk?
Patrick, do you want to weigh in on this?
Yes, I want to add to that from the insurance sector perspective. If you take the loss ratios of an insurance company, it's normally is what determines how risky is your business. Now, a good loss ratio is between anything 60 to 70%. Now, we can proudly say that our African average loss ratios is approximately 70%, while Europe is about 90 or even closer to 100% and above. So additionally, only about 3% of the world's largest losses occur in Africa. And I think is what my colleague has just also said. So all these statistics are saying that Africa insurance portfolio is not risky. So obviously, I want to admit that we have some challenges. We will not say it's easy to do business in Africa, which includes data adequacy and low insurance penetration. Obviously, this will help determine the overall complete outlook of our risk exposure at the end of the day. But yes, I think when you look at the real statistics, Africa is a place to do business in.
And this is an open question, because ultimately it always comes down to, in many ways, it comes down to the data that is available to assess how risky something is or how risky something is not. Sérgio, I know one of the wider arguments, or rather the wider goals of the World Bank Group is to, and your president, AJ Banga, actually said this quite clearly at the annual meetings last month, one of our businesses is to provide data, right, to make sure that that gap is essentially closed as fast as possible. What do we need to do to close that data gap based on the work that IFC has done in Africa?
Look, first, I do want to echo what I've heard from the other distinguished panelists in terms of this issue between the perception of risk and the reality of risk. And the data points that have been given today and this morning are very, very telling. I think it's very interesting to look at that. But I fully agree that in order to reduce the perception of risk and eventually reduce the risk, data is extremely important, and data is knowledge. And I think that's one of the parts you mentioned, the speech of our president at our annual meetings in Marrakesh. And by the way, it was the first time in 50 years that the annual meetings of the World Bank were taking place on African soil. I think that's also a message that we wanted to give, right? So what we need is a better knowledge, a better understanding, better access to information. And in today's world, with new technologies and so on, that information is also actually easier to gather. So I think one of the words that was in the video at the beginning was harmonization. I think the fact that we can capture data and information in many different markets. Africa is a complex continent with different countries, different realities. To try and gather that information is very important. On the AFC side, one thing we've done over the last 4 or 5 years, has been to have a presence on the ground. We realize that, you know, if you are sitting in Washington or sitting in 1 or 2 or 3 cities in Africa and you want to cover the entire continent, you will not get there if you're not closer to your clients, closer to the reality. So today we have a presence in 35 countries in Africa. We have a physical office with staff in 35 countries. We had it about 3 years ago. So I think that increase of presence is a way for us to get a better access to knowledge, a better access to information. And our role is indeed to share that. As a development institution, we don't get that knowledge for our own operations. We get it and we want to share it with others. And the second dimension when it comes to risk that I think is very important, and it's core to the strategy of the World Bank Group, is this notion of mobilization. Why? Because if we go together, I mean, financial institution, we all tend to actually have very often aligned views, right? So if you see, oh, there's 1 institution, 2 institutions, or 3 institutions going into this direction because they see opportunities, then others will follow. And we see that role of mobilizing capital, of bringing in other partners, and in particular, African partners, right? And that's one of the areas that we're really working on, deepening the financial sector in Africa, working with African institutions so that institutions look beyond their country, beyond their region, and as we all know, the continent is extremely vast, and you know, you come from East Africa, coming here and then working on all the continent. That kind of knowledge and bridge is something that we want to support. And if I may just add one point, which I think is also important when it comes to risk, and it's a part of the work we're doing, which is a lot getting in the trenches and sharing what we find in terms of information, and doing that work of capacity building, of governance of companies, of working on reforms, working on issues that are very pragmatic, and helping build those cases, build the examples of projects that are bankable, opportunities that are worth pursuing. And once we do that, financiers come. We see that. And in Africa, the opportunities are strong, so we do see that happening.
Abiola, I want to come to you on that question around data, because you're speaking to some really smart data scientists in South Africa and East Africa. One of the things that they often point out is, if I want to figure out, draw out a map of what your life looks like, one of the easiest places to do it with would be to look at your bank statement and figure out where these payments being made, at which petrol station, what restaurant are you going to, who's getting money in your account for your rent, etc, etc. I can draw a very good picture of someone's life with that information. And looking at the amount of data, transactions, savings, income statements that banks sit on, it's an enormous amount of information. But the flip side of it is, you can have an ocean of data, but how do you make sense of it? That's a big challenge for banks, isn't it?
Yes, it is, but I think that banks have figured that issue out, and we are investing heavily into interpretations of how to read those data. So I believe that the more investment we have into IT, the easier it comes, because data are useless if you can't interpret them. So banks are gradually investing into that. So I can query my system. If I want to query the system, it shouldn't be difficult if I want to look at a certain pattern of a particular section of my customers. So if I take government workers and I want to look at their life pattern, based on the data in my system, it should be that easy. I think what we need to do more is how to move the data to look at data across the industry as a whole. But in the banks, I think there's enough investment across, to handle those issues.
So how would you structure it? Say, for example, if you're working with Patricia's firm, right, in Namibre, they're saying, look, these are the risks that we're seeing on insuring farmers in, for the sake of argument, Namibia, Zambia, Zimbabwe. Jules will come in and say, I've got this data on what farmers are dealing with in East Africa. And yet, in some instances, regulators might say, no, hang on. That data can essentially just cross over from Namibia and go into Ghana or go into Nigeria. Do we need a common set of rules on data sharing across these jurisdictions as well to make your work easier?
Well, we are in those geographies where we are in the geography, I mean, in the country, it's easy to work across with that data. So if she's from, let's say, Kenya, and I have a risk, what we call the CRO, that's the risk person in that country, it's easy to profile the risk in that country, unique to that country. Because in as much as Africa is one continent, we also have varieties in terms of our outlook, in terms of the various risks on ground. So yes, we are able to use the same sort of criteria, but you marry it to that geography because they are quite different. So yes, she can be profiled. She doesn't have to be profiled as a Nigerian or a Ghanaian. So we can look at that unique opportunity and profile her to match that. So because the opportunities on ground across Africa are not the same. So if you take East Africa, for example, you will see that there's a lot of data as far as the infrastructure is concerned. It's more advanced. So it's easier to assess such a person based on the uniqueness of that geography. So it should be, I mean, we do that across where we are currently located. So it's very easy trading in Africa with that data in that particular sector.
Jules and Patrick, I want to come to you on this one. With respect to the question around how do we automate, right, some of these risk assessment processes across the board, because as we advance, we're throwing off, we're generating a lot more data in our financial systems. But when we have seen this in other markets, right, AI algorithms are programmed, they're deployed into the field, and based on the data that they've essentially been trained on, they bring certain sort of biases into the decisions that they make. How should we, as African financial institutions, as fintechs, avoid landing in that same trap?
I think it's data is, they say it's future gold. It's what when you need data to do anything that you are doing. So I would like to say that, yes, you will need the regulator. Our regulators will have to play a key role in making sure that we as the insurance sector and the banking sector they first need to harmonize the laws of the different countries so that we can do easier business in all the different African countries. So when the future of insurance, especially banking, is we are moving towards an open financial sector where the banks as well as the insurance sector will work together. Many of them are already working together. But that will then also lead to how we're doing pricing, on how we're assessing our individual clients. And that brings me, as an example, for instance, moving into parametric insurance and many other products as insurers and reinsurers. So yes.
In 30 seconds, for some of us who are not in the insurance space, give us a definition of parametric insurance.
Parametric insurance is also index insurance is very much based on when we, like for instance, when we talking about small-scale farmers, you can do specifically a product that is working and it's index-based. It's, for instance, linked to nature. So it, in order to...
So like something that will be triggered, like say, for example, if the rain doesn't show up.
Yes.
All right, perfect. Jules, the question around algorithms, data sharing, who should have access to the data, who shouldn't have access to the data, what ground rules would you like to have in place?
Yes, thank you. Yeah, so definitely technology is key. It's key to be able to leverage on data. But the view that we have at ADF is data is just a tool. And when you see the way the technology is moving today, it's moving quite fast. You know, we have IA, we have big data technology. I can tell you the type of instrument or technology that we have today in 5 years, even in 2 years, will not be the same. That moves very fast. Our challenge is mainly on the regulatory part. Can the regulation move as faster as the technology this all data technology. I give you an example. You know, most of the bank, they will have to deal with like the capital adequacy, you know, what type of provision they have to take every time they issue a loan. You have some assets that are the movable asset. Now, is how the regulation is taking into account those type of assets. The bank, they will have all the technology in place to be able to trace all like how these assets are moving. You know, so the bank, they will be very advanced in terms of capitalizing on the technology. But now, how the regulator also are moving to be able to take into account, you know, all this new technology, because you will come and tell them, I do believe that in terms of provision, I should take lower because of all this information that I have. Now, it comes down now to the regulator also to assess the data and say that they are comfortable with it. So I think that will be the main challenge. On the technology part, we are not very worried. It's mainly on the regulatory part to make sure that they can move as fast as the banks.
And that you can actually experiment with these things. Hopefully, by the time we have our closing panel with the central bankers on Thursday, we'll have some answers for you. In about 2 weeks' time, some of us will be in Dubai for COP28. And that's the note I would like to actually close on, because one of the things that I know we'll be discussing there is loss and damages. How do we make it operational? How do we raise the funds that some of our countries desperately need, right, to cope with this emerging wave of climatic threats that we have to deal with, if not now, next year, 2025, and so on. So that would be my closing question to all the panelists. Sergio, let's start with you. COP28, what solutions do you think we should expect from there?
I think COP28 is going to be a COP of pragmatism, of being very concrete on solutions that need to be deployed quickly. I think we all know numbers. We can do a lot of estimates of how many billions of dollars are needed in Africa for adaptation, for mitigation, but particularly for adaptation. I think for that, and this is what is very, very relevant for the AFIS, is Africa needs to strengthen, to develop and strengthen its climate financing. And we talked earlier about new class of instruments, and this is where we need to really pioneer. On the IFC side, we've been doing a number of green bonds, a number of different instruments that can be done for that, and we're very keen on supporting that. And then very quickly, the second point I would say is that Africa also, because we always talk about the riches of Africa in terms of minerals and so on, Africa has a lot of the products, the minerals that are needed to develop a climate-friendly economy. And what I think is a big opportunity in Africa is to develop the value chain around that. So let's not just export minerals, let's transform, let's do batteries for cars, let's do batteries for stocking energy. So all that transition is important, while keeping in mind that in Africa, still 43% of the population doesn't have access to electricity. So when I said COP of pragmatism, is because we do need solutions that will provide access to electricity to everyone. Green solutions, transition solutions, but that's what we need to work on.
Jules?
Yes, so COP28, in ADF point of view, is mainly how do we mobilize resources? Resources are there. I'll just give you an example. 10 years ago, the total volume of green bond that was issued in 2014 was 15 billion. 10 years later, in 2023, 600 billion. So we moved from 15 billion to 600 billion in 10 years. And when we are looking at the projection from the financial analyst, they're expecting that by 2050, the green bond market will reach an amount of $100 trillion. So at the COP28 is how can we leverage, how can we tap into that market to mobilize as much as resources, in Africa. Today, Africa only gets less than 3% of the green bond market. We need to increase that ratio. Yes.
Patty?
They call it the 3% curse. So if you say Africa also only contribute less than 3% to climate pollution. So my closing will be specifically to the insurance and reinsurance sector. We're very excited to be at COP this year, COP28. As last year already, we started to focus on loss and damage, and we, through the Nairobi Declaration, and we were at COP last year. So this year we have moved a step further. We are approximately 140 reinsurance and insurance and companies, as well as intermediaries, that are specifically focusing at coming to the table as insurers and reinsurers to write disaster risk as an insurance company, specifically focusing on loss and damage. So we're looking forward to get the funding from the COP28.
Hopefully that funding comes through. Abiola, you get the last word.
Yes, please. Thank you so much. I think my expectation is that we'll have greater collaborations, and Africa financial industry will take unique opportunity that the COP28 brings along. And I believe that we will need to quickly come up with very good products that will bring in what we call the banking inclusion. We still have penetrations of banking across Africa. Maybe the highest should be about 20%. Quite a number of people are still outside, and we need to do that. But I think the greater expectation that I have will be inter-Africa connection. Inter-African trade is a must. The figure out there is about 14% among ourselves. I expect that with the COP28, we'll take advantage. Banks will take the center stage. We will not sit on the fence. We will come up with products, innovative one, partner the fintechs, and promote inter-Africa connection. Thank you.
Indeed, and I hope that some of those deals will be announced at AFIS 2024. Ladies and gentlemen, your panelists, Sérgio, Jules, Betty, and Abiola. Okay, so as my panelists exit, I'm going to move on fairly quickly to the next stage of the conversation. We'll be hearing from two very interesting individuals who run some pretty fun institutions, well, fun if in finance and the development world. They've done some fantastic things over the period of time that they've been running these institutions. They're facing some immense challenges along the way. We will not be underplaying the challenges that we have to deal with across the continent. But I'd like to bring them up for this next conversation. Jeremy Owori is the Group Managing Director for EcoBank, who I believe is headquartered right here. So Jeremy, please come up. We'll also have in this conversation Sérgio Ekwe. He's the President of the West African Bank of Development.